A tip of the cap to you, and thank you for joining us on the Pilot Money Guys. We are excited to have you on this flight. And on this flight, we're jumping right into our lighthearted financial fun topic of the day, the strength of the dollar, banks and brokers, and private investments or private equity. I'm your host, wealth manager Robert Eklund, call sign Rubber Mallet, Captain Rubber Mallet now. And I'm joined, of course, by the certified financial planner, Charlie the Godfather Mattingly. Welcome, Godfather.
All right. Thanks, Rob. Good to have you here, man. I know you had a good time in New York, good vacation.
Yeah, and it's funny because I'm recording this, but I wasn't actually here for this one. So
No, I know we had to go it alone. We had to have the
alone.
professor.
Yeah, we
in.
got the professor. I wasn't here, so to record this content, and that's what we do here at the Pilot Money Guys. We're content creators. That's what everyone's saying these days. They're content creators.
all the kids
I don't
are
know
saying.
how much. Yeah, that's what the kiddos are saying, right? We're content creators here at the PMG. But we had Kevin the Professor Gormley with you, the Godfather, on this flight 55. So without further ado, here's flight 55.
All right, Kevin, welcome to Flight 55. Rob did an awesome intro for us. That's his gift. Nobody can replace him, right? So we appreciate that. But we're glad to have you, the professor, as a special guest today. We're going to talk some hardcore investing today. We're getting back to the nitty gritty. And it's fascinating stuff. A lot of stuff we've had questions about, things you and I have been thinking about and talking about. But first, we've got questions from the flight deck, things that we get asked occasionally. I actually flew around last week, Kevin. For the first time, I went to the airport, flew to San Diego from Nashville on Southwest. So it's scary.
Were you in the right seat or the left seat?
I was in the back seat.
Okay, good.
Yes, good. The back seat. I had a reserved seat. We didn't have to fly standby.
Nice.
Very nice. So Southwest did a good job. We got us there on time. We had a great time. So uneventful. So for me, though, I didn't have any flashbacks from being back in the airport. It was just a nice experience.
Well, Lisa was mentioning that you were drinking a lot, so maybe that's how you got through it, huh?
That helps a lot. That helps to numb everything. But one of the questions we get all the time, and I'm not an expert on it myself, but is this world currency, the US dollar as the world currency? What is that? I mean, what do you think about that? You've looked into this a little bit.
Yeah, so it's really interesting because what is currency? It's a medium of exchange. You exchange something with someone else, you need to give them something. So I'm gonna share, Charlie, for those on YouTube. I'm gonna share it's from Visual Capitalist. Can you see this okay?
Yeah, we got it.
Yeah, so this goes back to I think it's 2000 or excuse me, 1900. It goes all the way back and it looks at what's the world currency or what's the most popular currency during this time period. Let's see if I can get this to start again. There we go. And so, at the beginning of the 1900s, the pound was really the currency and the Deutsche Mark was the other currency. And you don't even see the US. Now, the US comes in sometimes, I think it's in the roaring 20s. But what's fascinating to me is that it does change a lot. It goes back and forth. And then the first fall or the death of the dollar happened in 1978 when the US actually came out with treasuries in Swiss francs in 1978 because there was a little bit of a loss of confidence. There it is there for those that are watching. But, the dollar is probably not going to be the world currency forever. As we've seen, at one time, if you said Great Britain, the pound was not going to be the world currency, people might have laughed at you. But like today, Brazil's president came out and said, we're going to use the yuan when we buy oil and as a currency. I do think it's going down multiple paths here. The first is that, hey, the U.S. is borrowing too much money, but we can get away with it as long as we have the world currency. The dollar is being used as the world currency. We just print more. Who cares? But then if the dollar is no longer the world currency, then we could get into a situation eventually where, inflation gets out of control. We have hyperinflation, et cetera, et cetera. Yeah. But Charlie, my view, Mohamed El-Erian, I don't agree with much of what he says. He's a very smart guy, by the way, but he always says the cleanest dirty shirt. So like somebody today called and said, hey, the dollar, this is terrible. I said, all right, what currency are you going to use? You're not going to use the dollar. Tell me the currency. And then he kind of chuckled. He goes, all right, I get your question. Yeah. Because what are you going to do? Use the Chinese yuan? Right. I mean, do you trust China as far as using their currency? I mean, the euro?
Yeah. So it's really about the strongest economy, and people can say, well, China's economy is just as strong. That's an argument. However, the U.S. still has the strongest economy in the world. And the thing that we have that China does not is the transparency. Like you just said, there's no transparency. So I would think as far as a world currency, that's an issue if you don't have all the information.
Yeah. So, and I think Britain is a good example, or United Kingdom, however you want to put it, because it's still there. And investors are still making money even after the pound, lost its tremendous, seat on the world stage as far as currency goes. And so Charlie, I don't know. I don't see this as a huge issue. I think the dollar eventually will lose its luster. Maybe there'll be some type of magical crypto currency that'll be the world currency. And, we'll still own good companies. We'll still own real estate. We'll still own other investments in that currency. So anyway, I just wouldn't take it too hard when all these people are trying to make you afraid about the king dollar falling.
Yeah. It seems like it rears its ugly head about every 3 or 4 or 5 years. And that becomes the scary rumor of the month. And correct me if I'm wrong, but I think the dollar has crashed before, depending on what you categorize, as a crash. We've experienced that, right? I mean, it's happened.
Yeah. I mean, the dollar has risen and fallen. And if you think you can figure that out, there's a lot of great currency trading programs out there. They're all BS. But it's one of those things that I do think diversifying internationally. I mean, this year, Charlie, foreign investments have actually done better than U.S. for the first time in a while. So diversifying, if you want to diversify currencies, but then you're getting into other risks.
That's right. And we're kind of diversified when we own foreign stocks anyway, right? Unless you hedge that currency, you are diversified somewhat. And sometimes that helps you, sometimes it hurts you, right?
Yeah, so our belief is to hedge currency with bonds, but not to hedge currency with stocks for the most part, because bonds only have a little bit of return and you don't want to lose the return because of currency.
That's right. Yeah. Well, awesome, Kevin. Appreciate that. The other 2 topics we're going to cover today, we're going to cover 2 more if we have time. If not, we'll just split it up. But they're fascinating. We might be a little late on addressing this topic, but still it's an evergreen topic as far as the banks. We've had the bank run earlier in March from Silicon Valley Bank, and then another failed as well the same weekend up in New York. Now, we're not going to go into those details, but we really want to know, and we want to talk about, is our money safe at banks? How much FDIC insurance do we really have? And then we'll talk about, what does that mean for your investments? Whether you invest as Schwab, Fidelity, Vanguard, what's the difference? There's SIPC insurance. There's a lot of stuff, a lot of moving parts, but the FDIC insurance, I think, is, in fact, they stepped into the bank. They guaranteed all the creditors, depositors, I should say. But what do you think, Kevin? Is our money safe at the bank?
Well, first of all, they only stepped in for those banks, Symphony Bank and Silicon Valley Bank. But they've kind of backstopped the crisis. But, Charlie, again, this is something else that we could fear. And let's talk about it and fear it and all that kind of good stuff. Because a number of people that have contacted us and said, I'm worried about the bank. I'm like, well, how much money do you have in the bank? They're like, I don't have much at all. And you're like, oh, okay. Neither do I.
Yeah.
So why are we so worried about this? So we've had a few clients though, Charlie, that have more than $250,000. It's unprotected from the FDIC perspective. So if you have a ton of money in the bank, the first question is, should you have that much money in the bank? But if you want to have it, there's ways to mitigate that risk as well, Charlie.
Yeah. We one of our friends is selling a house. They're going to get quite a bit of money wired to their bank account, more than the FDIC insurance amounts, and so we kind of talk about, well, what should we do? First of all, it's pretty easy to get more than $500,000 in FDIC insurance. And let me share my screen again, like we talked about for those YouTube viewers, and for those of you that want to check this out later, we'll provide this website in the show notes. It's FDIC, basically FDIC.gov, but again, we'll provide the exact link. But they have a calculator, Kevin, that's pretty cool. You go put your bank in there, and there's a list of banks that are under the FDIC protection. And most all of the banks would be there, I would assume, most larger banks especially. But first of all, since FDIC started in what was it, the 20s, 30s, it was pretty early on. I read today, just in preparation here, there's never been a loss as far as if someone had FDIC or came within those limits. Nobody's ever lost money in banks because of the FDIC insurance. So that was pretty interesting as well.
Yeah. So Charlie, you don't hear me say this often, but great government organization. Yeah. That is what defines FDIC. I mean, it's really been a tremendous help over the years. People always say government shouldn't get involved with things, but getting involved with this, I think, is terrific, and they do a great job. And the calculator, if you have a lot of money in the bank, this calculator is fantastic.
Yeah, absolutely. It's interesting because, and we've got flow charts. Kevin, you made a flow chart. We can share that if people want. But basically, I did a little demonstration on the FDIC website here to show that between myself, my wife, and our business, we could have $1.25 million in banks FDIC insured. Now, again, I'm not going to go through every line in detail here, but really quickly on this calculator, I put in that I have a bank of my own in my name. My wife, a bank account. Thank you. Yeah, my wife Lisa has a bank account. Those get $250,000 each, $500,000 together. So total so far, 2 bank accounts, same bank, $500,000. We have another account at the same bank that's joint. It's held jointly between me and my wife. That gives us another $500,000. So again, we're already at 700,000. No, we're already at $1 million. I'm sorry. There's $1 million right there. And the question you asked, Kevin, is the most appropriate. Why do we have $1 million in the bank? So anyway, but nonetheless, we could get another 250 from a business. Now, not everybody has a business, but Kevin, I think I can have another bank account and change the beneficiaries, right? And get another 250, I believe. Is that correct?
Yeah. So you can have your own bank account, and then you can have a half a bank account with someone else, and you get another 250. It's crazy. Yeah. Trying to figure out the rules. Don't try to figure them out. Just look them up. Yeah. But personal accounts, a joint account gives you another 2. Then if you name beneficiaries on accounts, also known as paid on death, that gives you, for every beneficiary that you have, Charlie, you get another 250,000. So this is one of those areas of finance to me that is so easy to fix. Mm-hmm. You just have to take 20, 30 minutes, maybe call your banker and ask them to do it for you, but to help you to just get the accounts titled correctly and the beneficiaries put on there correctly. So you're just safe.
Yeah, absolutely. As far as the banks are concerned, there's risk. Anything can happen. We can't discount any possible scenario. But think about putting money in your home or just keeping it under your pillow. I mean, the risk there is far greater of confiscation via robbery than anything else. So the banks are pretty daggone safe. And as we've seen, the government has a vested interest in making them safe because we got a feeling for what it might have been like when that one bank went out of business, SVB. Boy, can you imagine the ripple effect? The cascading effect of, hey, companies can't get to their money. Companies fairly big companies go out of business. People lose jobs and so on and so forth. The scenario gets pretty ugly pretty quickly. So the government is very concerned about making sure banks are safe. So that's a good thing.
Yeah, and Charlie, I don't want to bash media. Well, yes, I do. It's like cockroaches almost. The media just keeps looking for more cockroaches. So they'll start to say, "Oh, this bank looks like they're in trouble, and this bank looks like they're in trouble." And so the government came in, and I'm not going to say how they did it, but they kind of backstopped the whole banking system if people had long dated treasuries. But it's almost it's like it feeds upon itself.
Mm-hmm.
So they have to stop the feeding frenzy of all of this negative news, and that's what the government did there. So so at this point, I think we're pretty happy that banks are, it seems to have settled down. There doesn't seem like there's more cockroaches coming out of the woodwork, but anyway, we'll just have to wait and see. But I think as an individual, you can protect your money at the bank. And then if you want to put it somewhere else, Charlie, you could go to Treasury Direct and buy T-bills from Treasury Direct. You're buying treasuries from the U.S. government, or you could put it into a brokerage and do some other things that I know we'll get to.
Yeah, in fact, that's a good segue, Kevin, because the second part of this is SIPC. What the heck? SIPC insurance. You know what I mean? And that's Securities Investor Protection Corporation. I think I've got to double check that every time.
Who cares?
But anyway,
I mean, it's a snoozer.
It is
for sure.
It is a snoozer. And what does this mean? I read about SIPC protection, and the most interesting thing is how it came about. I don't know that I have that in front of me, but basically in the late 60s, so people started trading more often. They started trading, I guess individuals at that point probably caused an increase in trading. But what happened, Kevin, was brokerage firms started losing track. They couldn't keep up with the paperwork. So they were literally losing track of people's trades, how much they owned. There's a ledger that for you and I that says, hey, we own these stocks and these companies. And so they started to lose control a little bit. And again, Congress stepped in and said, hey, look, we've got to find a way to fix this in case these brokers go out of business. And so that's how they started. It was the Securities Protection Act. And so that's how SIPC came along. But real quick, it's a snoozer, like you said. SIPC is in case, theft or something nefarious, or your broker goes away, then it's going to give you $500,000 of protection, and $250,000 can be cash. Now, again, snoozer, because most people that are investors are like, well, I probably have more than that. And so there's other protections there as well.
Well, I think, Charlie, the only thing that's worth stating is that, banks, when you deposit money into a bank account, you're basically giving your money to the bank. They put it on their balance sheet. It's a liability. Okay. Before you start snoozing, all that means is that the bank, they're on the hook for your money. If they go bankrupt, you could lose your money. That's not how brokers work. Brokers are the middlemen or middle people. I don't know what we have to say gender neutral now, Charlie, but brokers are, all they do is facilitate, they hold your money and they facilitate your opportunity to buy other investments. So if you own mutual funds, or if you own exchange traded funds, if you own individual bonds, the broker does not put any of that stuff on their balance sheet. All they're doing is taking a small piece when you buy and sell those items. And you actually do own the underlying securities that are held within that fund.
Yeah. So let me back up just a little bit, because
sure,
the biggest, we want to differentiate, and you started to talk about it, like banks and brokers like a Fidelity or Schwab or Vanguard operate very, very differently. So people go, well, a bank goes out of business. What about Fidelity? Very, very different, because a bank is going to take your deposits, they're going to invest it, and they're going to loan it out. And so they're responsible for being a good steward of that. And unlike SVB, making good business decisions, et cetera, et cetera. Now, a broker or a custodian, whatever the heck we want to call them, broker dealer like Fidelity, they're going to take your money. And like you said, all they're doing is facilitating you and I for purchasing investments. And they can't take that money and do anything else with it. They don't even have access to that money. And so that's a big, big difference. Now, here's the thing, like a Schwab, I can't remember Fidelity, but a Schwab actually has a subsidiary bank as well. So that's where maybe people get a little confused.
Yeah, Schwab, thanks for muddying the waters for everybody. So now you're like Schwab Bank, Schwab the custodian. Which one are you talking about?
We had Bear Stearns go out of business, in 2008, and Lehman Brothers, right? So it happens. So what happens to our investments when those players go out of business?
So let's say that you have money at Fidelity, you invested into an iShares ETF. So if Fidelity, not that they would, they're a great run organization, but if they were to go out of business, you just somebody's going to buy their business, and your iShares is just going to go to a different place. That's what happened with Lehman Brothers. Neuberger Berman bought a lot. Barclays bought Lehman Brothers. So yeah, you're still going to own your iShares, whatever that ETF is. You're just going to have to probably go to a different website.
Yeah, that's exactly that's a good point.
And can you say it better? I don't think I said it that well.
No, I mean, I think that's it. It's really that simple. Now, who knows how it would exactly play out, but again, if you invest at Fidelity, they go under, then the next week, month, you're going to go to Schwab.com. Or vice versa, whatever might happen, and so that may be a good way to restate it.
Yeah. So one of my friends owns a bunch of wine, and it's held at a place, and so if that place were to ever go bankrupt, he'd just move his wine to another place. He'd still own the wine. So that's kind of how it works.
Yeah, absolutely. And I mean, obviously that would be a big deal. You're looking at some pretty difficult, terrible economic times if you've got companies like Fidelity, Schwab, Vanguard going out of business. That was a 2008 type thing. But I'll tell you what, for our listeners, Kevin, you and I both watched Ron Berger. Go to YouTube. It's in our show notes. He does a great job. He's a previous lawyer, and he's runs a very, very well organized YouTube site, very educational newsletter, etc. So he's got a couple really good 15, 20-minute videos on these topics as well. So go check that out. But Kevin, I think those are the two things as far as FDIC, banks, broker dealers, custodians, whatever you want to call them, Schwab, Vanguard, Fidelity. Those are the things I think that we're getting the most questions about. And I think hopefully that helps a little bit. Anything else you can think of there that we didn't cover on those?
Yeah. So I think for me, the biggest fear, having lived through and being a financial person in 2008, 2009, is when these banks and other brokerage firms start failing. It's just terrible for the economy. So I think, to me, if you want to have a fear, that's the fear. The fear of the cash in your bank or whatever, it's pretty easy to solve. So, and that's why I do like the fact, again, never praise the Fed in public and people will get mad at you. But I think that's the reason why I'm excited that the Treasury and the Fed came in and discussed how to fix this issue. And the FDIC, of course.
Right. Yeah. I mean, these are become political issues. Maybe they should or shouldn't be, but nonetheless, that's what, like you said, our news media likes to do. But nonetheless, I think our money is pretty safe, and other things to worry about if it gets going in that direction. But Kevin, so part 2 today, or next podcast, depending.
Break.
Yeah. It's been super fascinating lately. A couple of our clients, friends have brought to our attention. You and I have looked at these before over the years, but they're becoming popular again. I think they're becoming popular again because oil and gas is doing really well the last couple of years. I remember trying to purchase, back in the 90s and the decade of the 2000s, energy was awesome. I mean, it was a great asset class to own in and of itself. And then along came the 2000s and it was just miserable. I remember buying an energy ETF. In fact, I probably still own it. In 2016 going, it's going to turn around any day now. Well, fast forward 3 or 4 more years, and I think it's starting to do, what was it? When did it start doing well? 2020 again? Maybe 2021?
Yeah. I think 2022 was the year of energy.
Yeah.
Because I have owned energy for decades.
That's painful.
And and now all of a sudden the returns look pretty good.
Yeah, I know.
So I think you're right. It's like most investors, we say, what's doing well now?
Yeah.
I want to get in it.
Absolutely.
And then somebody calls and says, hey, you want to own an oil well? And you're like, yeah, I think it sounds good.
Yeah, look at these returns or yields that we'll talk about in a second. So that's part of it. Kevin, you and I have been in the business long enough now to go through a couple of these cycles. And so we've seen where, boy, again, I can't remember the exact time period, but 16, 17, 18, 19, 20, you are a fool for owning anything that resembled oil and gas, midstream, whatever, Exxon, you name the stock, energy in general was pummeled. And so, boy, you did not look smart for owning it then. But you know what? Maybe you should buy low. Who knows? We don't know how these things are going to perform, but nonetheless, they become more attractive when they do well.
Yeah, so I don't even look at MLPs or midstream companies that are publicly traded. I don't even look at them as the same as these other deals that are coming out with private companies, Charlie. And that's just because, any publicly traded investment, I don't care if it's a publicly traded REIT, a stock, a certain sector, it's going to have its dark days.
Sure.
What we see is something more so where people are starting to get excited about private investment that's not publicly traded. And they're promising, and you and I have been through this before. We got the T-shirt. I think you went to New York on a boondoggle.
A couple times.
Yeah. So because they throw a lot of money at us as planners that say, hey, the private investments, they don't go down. There's one price and you just get a dividend. So, the story of the fact that these things are private and the price stays the same and you just get your dividend year after year and everybody is happy and there's puppy dogs and unicorns all over the place. And you're like, yeah, this sounds really good.
Awesome.
So to me, it's not just about public, it's more about privately traded investment now bombarding our clients, Charlie.
Yeah, absolutely. So there's a specific scenario that kind of sent me down a path. A good friend of ours said, hey, check this out, 10, 12, 13% yield. In fact, I went to the website. They're not a registered investment advisor, so they can say whatever they want. You and I would probably be shut down and put in jail for saying that kind of stuff on our website. But basically it said yields 10, 12, 13%, no volatility. Same sentence, same line. I was like, wow, I want that. And then I started going, okay, let's dig into this a little bit more. But to your point, because it's private, good luck. I mean, it's not easy to get through these documents. The transparency is not there with the private like it is with a public company. That's by design. That's why it's private and not public. Possibly part of it anyway. So it's hard. It's hard to understand what they're doing. And the word yield, Kevin, I called you today. I was like, dude, let's break this down because, man, I want 15% yield, right? And so there's a lot to this though. So what do you think about this word yield or anything in general, as far as the oil and gas or mineral rights or private REITs? What do you think?
Yeah. So the word yield, all it means is that you're getting money, right? Now, how is that money being generated? Is it being generated from the business? Is it being generated from your own money? If I give you 100% of my money and you give me back 10% for a year, you can do that for 10 years, right? So it doesn't really mean anything. And so what people many times will think and say is that, look, this sucker gets a guaranteed 10%. And then you're like, guaranteed 10%. In finance class, Charlie, what we learned is that anytime someone says guaranteed 10%, it means it's a Ponzi scheme, right? That's about it. I mean, there's no, maybe an annuity in the first year, you'll get some type of super bonus or something, but there's no such thing as a 10% guaranteed. So then if you ask the people in the private companies, is it guaranteed 10%? They say no. The dividend could go up or down based on how the investment does. So you give me 100% of your money, I'll give you an investment that I can give you 10% for a few years.
Yeah,
I can definitely do that. Now, would I do it? Hell no.
Yeah. And again, the thing that I was digging in today and the day before was like, okay, so let me understand completely what it means when they say yield, because it sounds too good to be true. Probably is, right? So if I give a company $100,000, in fact, I was trying to look up I looked at some specific examples where if you go Google right now, just go highest yielding MLPs or LPs or some public, some private, but you'll see I saw one that was 15% yield. I was like, that's awesome. Man, I want that. But guess what? Just because I get 15% yield, and this is where you're going to get in the nitty gritty about mark to market, what's the price of the share? I can get 15% yield and I could lose principal. I think that's the concept that I want to get out there, because I could have 15% yield. And if I invested $100,000, I could end the year with $70,000, but still I got 15% yield. How's that possible?
Yeah, again, Charlie, if you and I were to invest in a business and the business is making absolutely no money, and yet it's giving us 10%, is that a good investment? I mean, come on, that's a terrible idea. What if you put money in an investment? You put $100,000 in the investment, and then 10 years later, they give you $5 million. That's a good investment. You got no yield. Mm-hmm. So all yield is, and look, I like yield. Dividends make me feel good. I'm not going to lie. I really love a good yielder. I do. I can't lie. So that's what they know. They know that people love yield. So it's really, when it comes down to it, it's really about the economics of the business. Mm-hmm. If I invest in you and you can make 10% per year and give me 10% per year, then that's something that's sustainable. But many of these businesses, it's sort of like dating versus being married. All they want to do with private equity is date you and get you to sign on the dotted line. Once you sign on the dotted line, they got your money. Yeah. And if they do well, that's good. If they do poorly, oh well. Yeah. We just go try to find another business.
Yeah, that's right. And just to that point, people have done well in private REITs, private oil and gas. There's nothing particularly wrong with it. It's just another type of investment. I think where we get off track a little bit is that we don't think of it like any other investment where there's good and bad. Any investment, there's pros and cons. There's no free lunch. There's a certain type of risk. Does it add diversification? I'll give an example real quick. Somebody with, let's say, no debt, great personal balance sheet. They're on track for retirement. They've got extra money. Hey, I need to invest more. I want to invest more. Maybe something that they can look into if they do their homework. Again, the websites will say sophisticated investor, but I'm just saying it has to fit circumstances as well. On the other hand, you've got me. I know a little bit about investing, but my life right now, I'm saving for college. I'm maxing out the 401ks, the IRAs. That's not in my wheelhouse right now. You know what I mean? So I think those are the really important things to think about too. Why would we invest in that? That's the first question. The second question is, hey, there's no free lunch. 10, 12, 13, they can say whatever they want as far as yield. Like you said, what's the quality of the investment? Does it make sense? Do you have all the information you need to make a good decision? And is it right for you? Those are the things I think about.
Yeah. So Charlie, a sucker is born every day. And, and you and I, we've been suckers in our life, unfortunately. Everybody has, but they come out with this messaging that's just terrific. And by the way, you and I, we could buy all of these private products for our clients. We just most of the time choose not to, because these companies, again, what are they looking for? They're looking for other people's capital, and they're looking to make money. And if you look at Wall Street, Wall Street first owned the banks, then they owned all the mutual funds. And guess what's happened with the efficient market hypothesis? They have a much more difficult time generating tremendous fees in publicly traded, because everybody knows that you own the index funds and you do just as well and you pay less. So now they've been really attracted to private, because there's a whole different duty that they have with private investors versus public investors.
Yeah, a whole different standard is kind of what you're saying, right? As far as the transparency, the information. Again, a website that says 10 to 12 to 13% yield, no volatility, absolutely not allowed on our website, a registered investment advisor, or even an investment advisor like a mutual fund, ETF, et cetera. It's not allowed. But in the private equity world, oil and gas, private real estate, there's land that you can do. There's storage buildings where you can buy the storage buildings for Amazon and all these companies that do the cloud storage, all kinds of things. And you're right, they call us all the time, but it's like, boy, you really got to work hard make sure that you do your homework. And oh, by the way, if I can go on the internet and Google these things and a attorney website pops up to talk about how they're suing people, I kind of want to stay away from some of those things sometimes, because why take on that risk at all?
Yeah, so that's one of the reasons why when people do get into these investments, they have to sign so many documents and initial 17 times on the front, because a lot of these private companies, they say, look, we're going to take your money, we're going to get other people's money. It's going to be in a pool, and we're going to invest it in real estate, or we're going to invest it in oil wells. And then if you want your money back, no, you can't have it back right now unless you die or become disabled. I mean, that's a pretty high hurdle. You got to become disabled to get your money back a lot of times. And so, because they say the money's invested, we can't just, but then they constantly produce these dividends. And the reason why you and I, Charlie, are no longer doing this, and maybe we've just had bad luck, but a lot of times when these companies have gone public, they've had a liquidity event. A lot of times they all of a sudden their 6% or 8% dividend, boom, it went down to 4%. Or what's even worse is when they go public and the price that they have per share all of a sudden drops by half. It goes from $10 a share to $5 a share. And then if you really liked your 6% dividend, you get a 12% dividend for a while because the share price has gone down. But then what always happens next is once you get those really high yields, like you talked about, the company says, this is a tremendously high cost of capital. We got to lower that sucker. Yeah. And so they lower it, and then the shares drop in price. So publicly traded, the whole idea of valuing a company is I think the most important thing with private companies is how do you value companies? So Charlie, how do stocks get valued today? Publicly traded stocks, how do they get valued?
So they're traded just thousands, hundreds of thousands every second of trades are going on. So you've got this bid ask spread thing going on where the price can be determined almost down to the penny, which is very unique in that market, which again doesn't exist in the private market. So a high yield can be very confusing sometimes because it's really all about the price per share or price of the investment, which gets very confusing in the world of private oil and gas, private equity, private real estate. And that's kind of what you're going to talk to now, right? It's just this mark to market idea of how that works.
Well, that's exactly right. And I'm going to show the people on YouTube the website called Zillow, which everybody's heard of.
Sounds familiar.
Everybody's gone on there at some time. So Zillow is actually, I think, a pretty good way to think about pricing. What's something worth? I mean, it sounds so funny to say what's something worth. Well, something is only worth what people will pay for it. So this right here, Charlie, where I'm looking at, this is Tellico Village. So this is a retirement spot near where we live. Very beautiful place.
Beautiful area, yes.
So what we see here, for those that are watching, what did I do to it? What we see is that there's lots of houses for sale in Tellico Village. It's a subdivision, a group of homes, lake community. There's lots of them. So if I put my house on the market and all of these sales have happened in the last few months, it's not just putting them on the market, but when they actually sell, we get an understanding what's today's prices, what's happening today. It doesn't matter what was happening last year. It matters what's happening today. Now you leave the beautiful community of Tellico and you come closer to where Charlie lives.
Yeah, there we go.
And there's just not very many and it's not coming up very quickly. I apologize here. There's like one dot per 30 miles. Okay. There's one house. Yeah. So this is what private equity is. Private equity is whatever price they kind of want to say, because there's not exact sales going on every single day like there is in public markets. So Charlie over here says my house is worth $10 million. And I say, Charlie, I don't agree with that. And you say, well, prove it. I can. How am I going to prove it? I mean, I don't see any other sales around. So this is, this is what, if you're going to go into business and have a fund, it would be nice, I think, to have a private equity fund, because every day you call me and you say, hey, Kevin, what's the price? I say, It's the same as yesterday. It's $10.
Yeah.
And you say, where are you getting that from? Well, we did our audit 3 months ago. And I don't tell you that I took the auditor out to lunch and we played golf over there at Tellico Village and all those other things that go on. So every day the price is the same. Who doesn't like that?
That's
and then you're getting your 10% dividends every year. Who doesn't like that, Charlie?
Mm-hmm.
Who's to say it's not $10 a share?
Yeah. 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 That's a great illustration. And that actually happened to me. I had to get two appraisals within a short period of time because of refinance, building, et cetera. And they were vastly different. And I was like, wait a second, are you looking at the same information I am? But anyway, the point of all that is in a private oil and gas, REIT, whatever, the yield becomes the thing that they can dangle out there because they get to determine the price essentially. And it's like, we don't know, maybe the price of my investment has declined significantly, but I still get the little yield there, which again, I could be losing money while getting a 12% yield. That's the point that I think we want to stress.
Yeah. And to be fair, these private firms, they hire a bunch of auditors at, the big accounting firms. These are not slouches. The problem is, Charlie, is if I have a house and you come over to audit it, of course, I'm going to put my best foot forward. I'm going to tell you, hey, look at this pond that's running by the house here. Look at this, look at that. And, when you start looking over at the garbage dump next door, I say, no, that's not a garbage dump, so I'm going to do everything I can to make my place look a little sweeter. And auditors are good, but, just like any other human beings, auditors are going to be, they're going to be getting a lot of their data from the company itself.
Perfect example of that, Kevin, is the Silicon Valley Bank was audited by one of the top 4, accounting agencies in the country. And in fact, an attorney I read said, hey, there's going to be an investigation and there's a good chance that they will be shown to have done no wrong whatsoever in their auditing practices. And the bank went bankrupt. So explain that one to me. That's above my pay grade for sure. But anyway, just, we beat the crap out of these private investments, and people will say, you just you all just don't do that. It's just not your thing. Well, sometimes people do make money in these things, but I think the point that I want to stress is, boy, if I see a website that says 10% yield, no volatility, I'm all over that. But like you said, that's called a Ponzi scheme. Bernie Madoff made 15% every single year, and that's how they got tipped off that it was a Ponzi scheme, because nobody does that every single year, 15% consistently. There's going to be some volatility, et cetera, et cetera. So that's kind of, again, where we're coming from there is just buyer beware.
Yeah, Charlie, I just have one final thing to mention that, this kind of always irritates me. And so if I come across as angry, I apologize. But, like the private equity group, they always put out data that private investments do better than public. They always put that data out there. And, I'm not going to get into the internal rate of return that they use, that they'll hold cash for a long period of time and it changes their returns. But I will get into the fact that survivorship bias in private companies is huge. I mean, the winners will win big, but did you get into those winners before they were those big winners? That's always the key. So, private equity might do a little bit better than public investment, but I don't think it does. I mean, there's actually a benefit of private equity that your share price never changes. So maybe they should be getting lower returns if we're thinking about rational markets. But all I can say is I don't think private investment for most people is going to do better than public. The curse of public investment is the volatility, and that's the allure of that 10%, hot chocolate, puppies, rainbows, unicorns. I mean, that's really exciting.
It is. Yeah. I think we've certainly, hopefully explained this concept. Again, can be confusing. What the heck does this yield mean? And how is this even possible? So that's kind of got me interested in going down that path as well. Of like, how can they advertise these things? But again, we can have a great yield and still lose money. That's the key. So Kevin, today, wrapping up our podcast, we've covered about three hot topics. You know, the dollar, is it going to crash? Is it going to be the world's reserve currency? We talked about the banks, broker dealers, et cetera, and then wrapped up with a private, equity type discussion, which is, I think, fascinating. So I'll finish this up. We're missing Rob today. He's out on the road flying. His schedule has changed. So I'm going to fill in with a couple of my favorite quotes. Mine are much less serious and significant than Rob's. He has some really good ones. He gets deep and meaningful. So here's my first deep and meaningful quote of the day to finish this up. My wallet is like an onion. Opening it makes me cry. I don't know who said that, Kevin, but I know that. Here's another quote. Sometimes all you need is $1 billion.
Yeah.
Yeah.
I think, what do you think? Hey, who can argue with that?
That's right. And finally, I'm stuck between I need to save money and you only live once. I don't know who said those quotes. I don't think anybody's credited because they're terrible, but nonetheless, that's me just, after we got angry and bashed these private real estate investments, I thought I'd lighten it up a little bit.
Yeah. And Charlie, we really appreciate when our clients bring us any and all ideas. We appreciate it because, it's intellectually challenging when someone says, why isn't this good? So bring your ideas, ask us questions, ask us anything. We're excited to talk about it.
Oh, awesome, Kevin. All right. Thanks, everyone. See you next time.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only. It does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from these projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.